look at these two investment funds and make a decision on which one you're going to invest in, you might decide to make the same decision as me and invest in the one that looks like it's going to skyrocket off and make you a lot of money. However, this would have been a massive mistake. If you look at the growth of £1,000 over the last 5 years, the first fund, which looked like it was doing incredibly well, would return you £1,622.65, and the second fund, which is a simple S&P 500 ETF, would have returned you £2,050.27. So you can see here that looking at most recent past performance is potentially not the best way to pick investments. Hello, my name is Rachel and welcome back to the channel. So in today's video, I'm going to go through this big investing mistake in a lot of detail, and I'm going to cover 3 really important lessons that I learned from making this investing mistake myself. I'm not sitting here trying to claim that I am a person that has not made investing mistakes, because I have, but hopefully you can learn from my mistakes and be a better investor yourself. So you will see time and time again statements like past performance is not indicative of future performance. A recent study from the University of Leeds showed that actually this statement might need to be reworded, and a 1962 psychology study from Jacobovitz explored why repetition can cause a word or phrase to lose its meaning. So even though you might have read warnings that past performance is not indicative of future performance, sometimes it's very easy to simply ignore this advice. And obviously it can be very easy to look at recent past performance and to believe that this is how an investment is going to perform into the future. As the famous investor Warren Buffett says, in the business world, the rearview mirror is always clearer than the windshield. So it's always easier to look back at past performance and try and use that as a guide rather than trying to look into a crystal ball and predict the future. So as I said, I have historically made decisions based on recent past performance, and the example that I used in the beginning of the investment in the Bailey Gifford American Fund has taught me an awful lot about investing. So there are 3 lessons that I have really learned from investing in that specific fund, and I wanted to share them with you today because I think that they will make a huge difference to the way that you might look at investing. Okay, so the first lesson that I learned from investing in this fund was that actually I would have been much better investing in an ETF. An ETF is an exchange traded fund, and it's simply a basket of different stocks. I prefer that ETFs are passively managed and you are not paying a fund manager to manage your investments for you. So generally the fees are much cheaper. And as I said, over 5 years, I would have actually done better investing in the S&P 500 than I would have done if I'd invested in this actively managed funds. So this helped me see a realistic example of where actually an ETF can do better, and often do better than actively managed funds. And if we look at Spiva's research, which is available online if you want to take a look at it, we can see that 87.98% of actively managed funds underperformed the S&P 500, and only 12.02% of funds outperformed the S&P 500, and this is over a 15-year period. So essentially I learned that I prefer to put my money into ETFs and index funds. Okay, so the next lesson that I definitely learned from investing in this actively managed fund versus investing in something simple like the S&P 500 is that you really do need to invest for the long term. Now, luckily for me, when I sold this actively managed fund, I had to sell it at the start of 2021, and it was very lucky that the fund was doing exceptionally well at that point. Now, the timing for that was not my clever timing. I wasn't trying to time the market. We simply needed some money for our extension that we were doing on our house. But had we have done the extension a year later and I had left money in that actively managed fund, everything would be looking rather sour for us. So what this really taught me is that if I need money in the next 1 to 2 years, it makes much more financial sense to have it in something like a high interest savings account, or potentially in premium bonds, or in a cash ISA where you are getting a good interest rate. As obviously the stock market does fluctuate, and if you need money in the next 1 to 2 years or the next few months, it is much better to have that money set aside than to risk losing it. And if you do need that money fairly soon, then you will definitely be sleeping better at night than you would be if you left it in the stock market. So I always say, if you're looking to invest in the stock market, it is better to be looking at a time horizon of 5 to 10 years, or potentially if you are going to retire, it's good to invest your pension, obviously. So definitely investing is much better if you have a much longer time to ride out any peaks and troughs in the market. And Warren Buffett certainly agrees with this. He says only buy something that you'd be perfectly happy to hold if the market shut down for 10 years. And then the third and final and potentially the most important lesson that I learned is not to focus on investing in specific trends or themes or the latest new thing. If you're hearing people at work or say on the school run talking about a specific investment, then potentially it's too late to get started with it. As Warren Buffett says, beware the investment activity that produces applause. The great moves are usually greeted by yawns. So sometimes it is a really positive thing to simply go with a very boring investment, because sometimes the ones that sound very exciting are too good to be true. If you look at some of the marketing material from actively managed funds, for example, you'll see that they might be talking about thematic investments or disruptive investments or game-changing investments. And although they could be interesting investments, they could also be investments that might crash and burn. Any questions, please do pop them in the comments down below and I will get back to you with any answers. Thanks so much for watching and have a lovely day. Bye bye.